asset allocation in the investment world, I like to think about, when you and I talk about taxes, I like to think about tax allocation as well. In other words, you've got different types of accounts that you can have money in. You've got a taxable account. That'd be like your bank accounts that earn interest, CDs, money markets, those types of things, taxable stocks and bonds and those types of things, even income for real estate. That's all taxable type income, right? And then you've got tax deferred investments. That's like your IRAs, traditional IRAs, your 401ks, or the traditional side of the 401k. It's tax deferred annuities, those types of things. And then your tax free. And the best tax-free source out there, obviously, is the Roth IRA, because that can be invested in virtually anything. And then you've got your tax-free bonds, but they're not always tax-free. They can cause Social Security to become taxable. And then some life insurance policies have some tax-free benefits. But Corey, talk to our listeners and viewers here about how you think about tax diversification and how important it is to decide in advance where you're going to source your income from each year.
Yeah, so you hit the nail on the head there, Dean. It's a lot of this comes down to cash flow. Where am I going to draw the assets from? But the other distinction I want to make here is I talk to a lot of people on a day-to-day basis, and make sure you understand that there's benefits to each one of these different locations that you described. Brokerage account, I can get tax-free income by utilizing that 0% tax bracket. The IRA accounts, we never paid tax on that money. I can give it to charity tax-free when I'm over the age of 70 and a half. This is a QCD. The Roth, obviously great tool for accumulating wealth, getting tax-free growth, and legacy play. So understand that there are benefits to each one of these three different buckets. The way I'd say it is, I don't show up to a construction job with just a hammer, because everything starts to look like a nail, right? So make sure you've got all of these different buckets established, and that gives us flexibility out into the future to manage these assets appropriately. But everything comes down to cash flow. Where am I distributing from? How am I doing this most effectively?
Yeah, Corey, you make a lot of sense there. And, kind of some people might go, man, this is making my head hurt. How do you guys love talking about taxes? And here's my take on this, Corey. I hate paying taxes, right? I don't mind paying what I owe, but I want to make sure that I'm setting myself up to pay only as much as I owe. And I do that by planning. One of the things I think that people lack a good understanding of is another source of income that just about everybody has, and that is your Social Security income, because Social Security is taxed different than any other source of income, and it's taxed different than any other type of asset. Corey, explain how Social Security is taxed and how doing certain things can actually cause double taxation and throw you into a much higher bracket than what you thought you were going to be in.
Yeah, so I won't go too deep, but if anybody wants to do some research, look up provisional income. This is a different term in the tax code that relates to Social Security. But in essence, Dean, the way this works is the taxation of Social Security is a sliding scale. If Social Security is your only form of income, potentially 0% of that benefit is even included as income on your return. As you start to add other forms of income, this drives up your provisional income, which causes more of your Social Security to be taxable.
Yeah, so that's the crazy thing. And people will go, wait, hold on, Corey. I took $10,000 out of my IRA. I'm in a 12% bracket. How do I owe $2,000 in taxes on that? I'm in a 12% bracket. Doesn't make any sense. But what you're saying is, well, because you added to your provisional income, that all of a sudden made more of your Social Security taxable. So you didn't just have to pay taxes on the IRA distribution, you had to pay taxes now on more of your Social Security. So this is where, Corey, I think the long-term planning comes in. And if somebody's out there today and they haven't started taking their Social Security yet, let's say they're 55 years old or 50 years old, as they're doing their financial plan, and I want you to think about this, ladies and gentlemen, as you're doing your financial plan today, how much time has your certified financial planner taken to actually say, here's the Social Security claiming strategy that is going to optimize not just Social Security, but it's going to minimize taxes over your retirement years as well? Because those two things, Corey, go hand in hand.
Very much so, Dean. And we will tailor our Roth conversion or our distribution strategy. All of those things need to be working together. This 0% capital gains that we've been talking about here this morning too, that increases my provisional income. So I thought I got 0% capital gains, but I ended up paying 10% because of my Social Security implication. So this is a complicated area, Dean. Everything needs to be working in tandem. I say the left hand always has to know what the right hand's doing.
Yeah, I mean, $1 somewhere could affect something else, and that's why I was talking about the tax diversification, Corey, because you have to understand that it's how the income you take is combined together. It's not all income is not created equal. Yes, it all goes into your bank account. Yes, you spend it all the same way, but the IRS doesn't see it that way, right? There's ordinary income, there's capital gains, there's qualified dividends, there's short-term capital gains as opposed to long-term capital gains. There's Social Security income. There's tax-exempt income from municipal bonds that can trigger Social Security to become taxable. There's all these different things, and none of them play nice together. And if you don't understand how they're working, Corey, that's where people wind up paying more tax than what they have to.
That's 100% correct, Dean. It's a difficult game to play. It's important to have this long-term perspective and really understand how all these different items impact each other. We might be taking too much income on any given year. We might not be taking nearly enough income on any given year. We see it all across the board, Dean.
So here's the question I would have for everybody watching or listening. If you're paying more tax than what you need to, when do you want to know about it? After you've already paid it or before so you can do something about it? Corey, we're going to wrap up here with our Don't Do That segment. Here's the scenario. You've got high income, $300,000. You write a $1,000 check to your favorite charity at the end of the year thinking at least I get a deduction. Well, what did I miss?
We missed this new floor from the One Big Beautiful Bill Act, Dean, here where the 0.5% of our donations don't count anymore. So this is something that we'd want to think about where maybe we look at staggering our deductions, right? Our favorite charity, we want to give them $1,000 a year. Maybe this year we give them $2,000. Next year we don't give them anything. Maybe we look at a scenario where we give them appreciated stock. Maybe it's a scenario where we look at a donor advised fund. But charitable donations are complicated anymore. And we want to make sure we maximize the value of what you already plan to do anyways. There's a couple different ways we look to optimize that.
Corey, we've covered a lot for our viewers and listeners here. Thanks for taking the time out of your busy schedule here during tax season to talk about how taxes are changing here in 2026. And I love the comment that you made earlier. There's something that's always permanent in Congress, and that is change. So even though they said, hey, the Tax Cuts and Jobs Act is now permanent, well, it is at least until the next administration. Corey, thanks so much for taking time to join me here on America's Wealth Management Show. Until next time, everybody stay healthy and stay safe.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment tax or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.